short-term future of European oil refining came into sharp focus last week, and it doesn't look pretty. I'm Thomas Warner, and this is the Argus European Products Wrap. Low road fuel margins and a supply overhang that the IEA thinks will be with us until around Christmas has got European refiners looking closely at their portfolios. Neste announced last week that it's considering turning its 197,000 barrel a day Porvoo site into a biorefinery, saying that the COVID-19 pandemic has substantially accelerated the decline in demand for oil products, which is not expected to recover to previous levels. Major units at refineries around the continent remain offline, with a CDU at Petroineos' Grangemouth facility the latest to join a growing list. Saras turned off one of the CDUs at its 300,000 barrel a day Sarroch refinery back in August, and Repsol turned off the small CDU at its 180,000 barrel a day Tarragona refinery around the same time, citing insufficient product demand, and is now using the unit intermittently. The road fuel supply overhang continues to steer prices here in Europe. French diesel margins last week fell to their lowest level since June 1999 at around $2.53 a barrel from $18 a barrel a year earlier. Gasoline margins proved more resilient, hovering at around $6 a barrel, which is as high as they've been since the onset of the COVID-19 pandemic, as floating storage volumes cleared to North America and West Africa. Looking ahead, we could see more announcements from European refiners about how they plan to deal with a weakening demand outlook. The IEA has suggested that refiners shift away from their traditional emphasis on road fuel production in favor of naphtha and fuel oil. But will that be enough to stop more units coming offline in the short term and more refineries coming offline in the long term? Whatever happens this week, you can stay on top of all the latest refinery news and get daily updates from across the barrel with the Argus European Products Report.